Now, Spider is behind some of the most popular ETFs in the market. And here today to break down some key ETF investing strategies is Matthew Bartolini. He's head of Spider America's research at State Street Global Advisors. Thanks so much for joining me today, Matthew.
Yeah, thanks for having me.
All right, so when it comes to investing in ETFs, you can utilize them to get exposure to sectors. So how should investors be utilizing sector ETFs in their portfolios, and why are ETFs a good tool for them to utilize to get that exposure?
Well, within sector ETF strategies, it's predominantly around rotations, so sector rotation strategies, and we see a lot of different ones out there, whether it's thematic based, what's going on in the marketplace, are interest rates rising, so you go towards more interest rate sensitive sectors. Then there's also a quantitative way to look at it by looking at, say, momentum or value, and then also top down, so understanding what the business cycle is doing. And we did a lot of work on business cycle investing and figuring out which sectors work well on average in which business cycle. So like in a slowdown, it's usually healthcare because you're placing more emphasis on corporate profits. So there's understanding the use cases of sectors is helpful, and then you can also just be really thematic. During earnings season, tech sectors growing their bottom line and they're a high performer. Going into something like a tech sector and maybe not going into tech stocks like singularly, because you can mitigate that stock specific risk by being in a diversified basket. So sometimes you can get the stock call wrong, but the sector call right. So we always like to look at sort of sector ETFs as a way to play those thematic views.
Yeah, and shifting gears a little bit to talk about the low-cost ETF offerings with the portfolio suite, you can buy the market essentially with SPY, and also we have SPLG. How is that offering differentiated?
So SPLG is part of our low-cost portfolio ETF suite, and it has a consistent share price across that suite of around $30 to $40, and also has a low expense ratio. And I think that's more attractive to investors that place a higher emphasis on expense ratio and that total cost of ownership equation, but also ones that might have a low minimum account size for model portfolios to efficiently allocate capital. That low share price is helpful. Conversely, for SPY, that's more attractive to institutional active traders that favor a high share price, particularly if you're getting charged commissions on a per share basis, but also the robust liquidity. It trades $20 billion a day. The implementation flexibility is really beneficial. You can sometimes remain anonymous in how you trade, and you don't really have to worry about your sort of execution strategies as you would in maybe other products that don't trade as much. But overall, we continue to sort of think through it that we're providing investor choice on how you invest in the S&P 500, whether it's around liquidity in bid-ask spreads or during low fees and low share prices.
So even with this new offering, you don't see SPY going away by any means. What do you think the future is now that we have these different offerings?
Yeah, both products are with a purpose. Investors allocate portfolios differently and have different purposes for products. SPY is a liquidity sleeve, SPLG maybe a buy and hold long term. So I think there's a place for both in a portfolio, but also separately based on your user preference. And that's what we're going through here with that client demand. Not every client and not every portfolio is alike. So being able to meet that investor choice in something like this, all within the State Street universe, I think is really helpful for us, but also to educate our clients on asset allocation.
And you mentioned buy and hold. So whether you're buy and hold or you want something more flexible, I guess taking a step back, how should investors be thinking about building their portfolios with ETFs?
Yeah, just from an asset allocation perspective, first and foremost, I think also with the changes you referenced, we were able to harmonize our exposures across consistent lineups. So all the same methodology, all S&P based, no gaps or overlaps. Understanding the bottom line exposure is really important. Are you having dual exposures to certain types of areas? But then also understanding what your costs are to own that. And we've been preaching a lot about total cost of ownership, understand the expense ratio, but how much you trade and how frequently you rebalance will impact your total cost based on the bid-ask spread you're paying. So understanding not only risks from an asset allocation perspective, stocks versus bonds, but also what the liquidity risk in your portfolio is, which I think is really important as we get into a next decade, because we just exited one that never seen a recession in the US, didn't have a US bear market, and you need to think about liquidity management for the next decade and really what's probably not going to be the not so boring 2020s.